Hi, welcome all to this webinar. As you are all aware, Sarbanes-Oxley Act is a vast subject. But in 1 hour, it is not possible to go to everything. But at the end of the webinar, I expect that we will have a better understanding of Sarbanes-Oxley. So let's start. Okay, the content of this webinar is what is SOX, why is it enacted, important sections of SOX Act, what are various punitive provisions under SOX Act, methodology for compliance, the influence of SOX on the Indian companies, and various benefits of SOX implementation in various organizations. So let's see what is SOX. SOX is basically an act in US law enacted in July 2002. It derives its name from its architect, Senator Paul Sarbanes, and Representative Michael Oxley. So they have taken as from Sarbanes and Ox, last name Ox of Michael Oxley, and come up as SOX. So it is basically a mandatory act, and all public entities must comply with SOX. In simple terms, SOX is a set of standards that is applicable to all public companies and public accounting firms that must comply and adhere with good quality of financial reporting. So why SOX? Early 2001, there were various scams that shook US. The most important one is Enron. As you are aware, Enron was the seventh largest US-based company, and due to a whistleblower, it was investigated for its complex network of offshore partnerships and accounting practices. It had basically used special purpose entities, SPEs, to move debt off the balance sheet and transfer the risk for their other businesses. On investigation, it was found that there were major financial irregularities, and they were charged for fraud and negligence. The next one is WorldCom. WorldCom is the largest US long distance phone company. In 2002, they were probed for suspicious act of increasing profit when other telecom industries were losing. On investigation, it was found that it had inflated its revenue by wrong accounting practices. And in 2004, it was declared bankrupt. Third one is Tyco. In 1999, they were invested for its reporting anomalies. At the end of the probe, it was discovered that CEO and CFO of Tyco had hoaxed multi-million dollars by way of bonuses and misuse of employee loan programs. So, in wake of all these scandals, SOX Act was introduced to establish investor confidence in the corporate governance, strengthen internal control mechanisms, ensure that full disclosure in financial reports are carried out, and transact corporate governance with full transparency. That is why this SOX Act was enacted. So what did the Act did? It added new financial disclosure requirements. It increased CEO, CFO responsibilities, and which included penalties. Created a public company accounting oversight board. It is called as PCAOB with standard setting investigative and disciplinary authority. They strengthened auditor independence rules and added internal control reporting requirements. We'll go through that in the next slide. So, SOX Act has got various provisions. It is not possible for us to take all the provisions in this webinar. So, what I will do is I will take you through key provisions of SOX. The main section is 30. One of the important section is section 302, wherein public companies are required to file regular reports with Security and Exchange Commission. The top executives, that is CEO and CST, must personally vouch for the information contained in these reports and are responsible for establishing internal controls of data. Then other provisions, key provisions are section 404 and section 409. Section 404 requires annual financial reports to include a section on these internal controls assessing their effectiveness. Means they have to assess the effectiveness of internal controls. Any shortcoming discovered in these controls must be disclosed. Disclosure is very important and critical. It has to ensure that registered external auditors must vote for the management assessment of internal controls. As mentioned, external auditors has also got different responsibility and they get punitive. Then another important section is section 409. Any material changes in the financial conditions or operations of the company has to be disclosed to the public in a timely manner. Coming to other sections, section 802 talks about criminal penalties. This is very critical and it imposes penalties up to 20 years imprisonment for altering, destroying, mutilating, concealing, falsifying records or documents with the intent to obstruct, impede, influence a legal investigation. It also imposes penalties up to 10 years on any accountant or auditor or any other who does who violates any requirements knowingly, willfully, or unknowingly. The requirements of maintenance of all audits of review or papers for 5 years. What is the other important section? One of the most important section is 906. It addresses criminal penalties for certifying a misleading or fraudulent financial report. Under this section, penalties can be up to 5 million in fines and up to 20 years in prison. So, out of various provisions, most critical amongst SOX is SOX 404, and most of the organizations implements SOX 04 and gives importance to SOX 404. Crux of requirements are section under 404A, which prescribes rules requiring each annual report to contain an internal audit report, which will include the responsibility of management for establishing and maintaining an adequate internal control structure and procedure for financial reporting. And two, it must contain an assessment as of the end of most recent fiscal year of the effectiveness of internal control structure and procedure of the issuer for financial reporting. And section 404B talks about report to be audited by an external auditor in accordance with auditing standards established by PCAOB. In summary, section 404 requires four things. One is the statement of management's responsibility for establishing and maintaining adequate internal control over financial reporting. This is very critical. Management's assessment of the effectiveness of company's internal control for financial reporting as of the end of the company's most recent fiscal year. Here, the management has to ensure that it has compared with the effectiveness of the company's internal control. Statement identifying framework by management to evaluate the effectiveness of the internal control over financial reporting, and the statement that the external auditor has issued an attestation report. You know, they cannot just say that, you know, internal controls are working. It has also to be attested by an external auditor to support what the management is saying is true. Another critical requirement of SOX 404 is that the management cannot preclude in concluding that the effectiveness of the internal control or financial reporting is there if one or more weakness is identified. Means if the auditor finds that there are more than one material weakness is there in the system, they just cannot preclude in concluding that, you know, there is effectiveness in the internal control. The rule also requires the management to disclose any material weakness identified during the course of the evaluation. Means the management has to disclose if there is a single material weakness which is there in the system and which has been identified during the course of the review or evaluation. So what is material weakness? Basically, any material weakness exists if it results in more than a remote likelihood that a material misstatement in the financial statement will not be prevented or detected. Means if there is a control lapse and it is found that, you know, it is found that this control weakness would lead towards a material misstatement in the financial statement. Okay, is not able to be prevented, that has to be reported. And second part is significant deficiency. What is significant deficiency? It is one that results in more than a remote likelihood of misstatement. That is more than inconsequential. Meaning, if there is a likelihood of mismanagement, okay, that cannot be identified, that has not been identified, means that it is a significant deficiency in the system. Anything other than the material weakness and significant deficiency is control deficiency. Means this would be avoidable weaknesses, but it will not be material or significant. But the management must take the action to fix these control deficiencies. It is important that we have to comply with all these provisions. So how do we do that? The first stage is planning. During the planning, what do we do? We have to understand the definition of the control system. Then organize a project team to evaluate these internal controls, whether it is if it is working properly or not. Next stage is the documentation part. We have to, as part of documentation, we have to evaluate the internal control at the entity level. Once we do that, we have to understand and evaluate the internal controls at the process transaction or at the application level. This will include the entire processes, transactions, and what all applications are being used. Then we review the entire, we evaluate overall effectiveness, we identified methods for improvement, and establish monitoring systems to ensure that these issues are fixed. Then finally is the management report on internal control and independent auditors report on management. During the planning, what are the important things we have to carry out? We must have to organize and explain the project. Define the internal control framework of the company or its subsidiary levels. Draft initial milestones plan. Identify and validate significant accounts. Map significant accounts in business processes. Select project technology tools. We have to define the roles and responsibility of the company, subsidiaries, consultants, and the external auditors, basically scopes. And we have to estimate the future project results required by the business changes. As part of documentation, we have to identify documents and evaluate entity level issues. Determine the process and control documentation requirements. Deploy project technology tools to identify users and conduct global user training. Document processes, financial statement use, and related control. Then one of the critical thing to go through is walkthroughs. When we perform walkthroughs, we get a fair idea of the designs of controls and how it's working. Then the next level is evaluating the entire controls, execute the testing process, then testing is identified, identify control deficiencies, and determine the corrective action. That is very critical. Once you identify control deficiencies, it is important that we have to determine the corrective action for each significant accounts and business units. Next process is to review. Once we review, during the course of review, we have to implement corrective actions and then retest, so that whatever risk we identified and takes final organization and review of project documentation. Then the CEO and CFO review and assertions. Ultimately, they will have to assert the working of the controls and confirm the timing of the external auditing. Finally, external auditor does the entire evaluated compliances, and then the management assertions. So under each one of these areas, we have got controls identified, and critical points to consider are whether the control environment is working fine. Under the control environment, what we have to consider are integrity, if integrities, ethics, behavior of executives, control, consciousness of the organizations, etc., are working in order or not. Then the risk assessment part. During the risk assessment process, we have to identify mechanisms to anticipate and react to changes, etc. Process to identify changes in gap and internal controls. During the risk assessment, we will be able to identify the mechanisms to ensure that proper risk managements are there in the system. Then the control activities. We have to consider that the necessary policies and procedures are existing in the organization. There are clear financial objectives defined in the system. There are appropriate segregation of duties available in the system. There are periodic comparisons of budget to actual evaluation is done. There are adequate safeguarding of assets and records. Managements are happening into this. Then the information and communication part. We have to ensure that adequate performance reports are produced. These are connected with business strategy, and develop these to test, monitor the IT systems and programs. And finally, for evaluating the internal controls, it is important that each one of these are monitored. It is important that there is a system of periodic evaluation of internal controls happening in the organization, and these are implemented for improvements as recommended, and the internal control function ensures that there is a continuous review of the entire process and systems in the So, what is the influence of SOX on the Indian companies? Basically, SEBI added clause 94 clause 49 to the listing agreement in 2000. This was before SOX was implemented. Okay. So what SOX, after implementation of SOX, what SEBI did was to revise the clause 49, so that it comes in line with what Sarbanes-Oxley Act did by the US government. So various control mechanisms were included in clause 49, and many acts were added into the existing clause 49, which was implemented in the year 2013. In the year 2013, companies had took major steps. They raised their bar so that corporate governance in India has good control over various management and the auditors.
Mr. Pitambaram,
Yeah.
your voice is coming very low, and in between there's a gap.
Let me check.
Yes, could you please be a little louder?
Yeah.
Yes, thank you.
Hello. Is it better now?
Yes.
So I will start again. What is that?
Thank you.
Yeah. So how did SOX influence on the Indian company? Basically, SEBI added clause 49 to the listing agreement in 2000. This clause was enacted with the aim of improving corporate governance of all companies, all listed companies on the Indian stock exchanges, including NSE and BSE. In 2004, after SOX was implemented, the clause 49 was revised to bring it more in line with Sarbanes-Oxley, enacted by the US government. The Companies Act 2013 took major steps in raising bar on the corporate governance in India. This act actually imposed specific responsibility on the board, audit committee, management, as well as the auditors. This is in line with what we have in Sarbanes-Oxley. It requires the board to state that they have laid down internal finance controls to be followed by the organization, and such controls are adequate and are operating effectively. So you can see that SOX Act actually helped in bringing more transparency and controls even in other parts of the So, what are some of the benefits that SOX implementation bringing to the organizations? We have to remember that SOX 404 is not only a documentation; it focuses on important risks and controls. How does it help that? It strengthens the control environment in the organization, because it involves the entire review of the control environment. not only by the internal systems, but also by the external auditors. So once the entire control environment evaluation is done, it actually helps strengthens the control environment of the entire organization. With the focus on documentation, we in the organization will have improved documentation. Means there will be documentation in the system, but it will not be in an organized manner. But when we implement SOX Act, documentation plays a major part. And once we arrange the entire documentation process, we have an improved documentation available in the organization. With such vast requirement from the authorities, okay, it increases audit committees involvement, because audit committees are worried that something goes wrong. The entire organization, not only the entire organization goes for a task, the management also goes. So the audit committee's involvement increases. It helps in experting convergence of it. Means we can add various process and systems and see that uh, the best practice are carried. So there is a convergence opportunities which can be exploited. The next benefit of documentation is standardizing the processes. Okay. Standardizing process is a very critical element in any organization. We have to ensure that the process are standardized so that any employees in various business units understand and carry out the processes and system according to the various policies as followed by the organization in entirety. Okay. You cannot move in some direction in some business units and some direction in other business units. So you have a standardized process and systems, and that is another benefit of such implementation. It reduces, it helps in reducing the complexity. Means there are many there will be many processes and systems in the organization which will not be working or which is not required. So what SOX does is it reduces the complexity. SOX has got standard processes and systems, which once is implemented, redundant process and systems can be moved out. So this way it helps in reducing the complexity. Design it helps in designing the product to extract value. What does it? It helps in improving the processes and systems. It helps in having consistent policies and controls. As I was saying earlier, it reduces the duplicate controls. Duplicate controls or redundant controls which are not required. So It basically helps in reduction of duplication. So these are some of the benefits of SOX implementation. That's it from my side.